Let me break down the three key differences between MICs and REITs that will help you decide where to put your money in Canada. First, what you're actually investing in, mortgages versus physical properties. Second, how you make money, interest payments versus rental income and appreciation. Third, how quickly you can access your cash, private investments versus publicly traded shares. Here's what caught my attention when you looked at the 2008 financial crisis data. One of these investment types held steady while the other dropped with the stock market. Each difference impacts your returns, risk level, and investment strategy in ways most people don't consider. Under Canadian regulations, MICs must keep 50% in mortgages, while REITs need 75% real estate income. Let me know in the comments which difference matters most to your investment goals. But first, we need to start with something most investors completely miss about these two options. When you invest in a MIC, your money goes into a pool that gets loaned out as mortgages to borrowers who need financing for real estate deals. Let's say you put $10,000 into a MIC. That money combines with other investors' cash to create a lending fund. The MIC then uses this fund to provide mortgages to people buying houses, investors purchasing rental properties, or developers building new projects. Your investment becomes part of someone else's mortgage payment. You're essentially becoming the bank that lends money secured by property. The MIC acts as the middleman between you and the borrower. MICs vet borrower credit and secure loans with high loan-to-value cushions, typically maintaining maximum ratios around 75%. When someone applies for a mortgage through the MIC, the company evaluates their credit, income, and the property they want to buy. If approved, the MIC uses your pooled money to fund that loan. The borrower signs a mortgage agreement and starts making monthly payment. Part of each payment covers the loan principal, and part covers interest. The interest portion flows back to the MIC, which then distributes it to investors like you. With REITs, your money goes toward buying actual buildings, shopping centers, apartment complexes, and office towers that the company will own and manage. REITs must derive at least 75% of their income from real estate under Canadian regulations, which underlines their structure as property-focused investments. When you buy REIT shares, you're purchasing a piece of a real estate portfolio. The REIT uses your investment to acquire properties, renovate existing buildings, or develop new projects. They hire property managers, maintenance crews, and leasing agents to operate these buildings day to day. A REIT might own 50 apartment buildings across the country. Your investment gives you a small ownership stake in all 50 buildings. The REIT collects rent from tenants, pays for building maintenance, covers property taxes, and handles all the management duties. You don't deal with tenants or repair calls, but you own a fraction of the physical real estate. MIC investors own mortgage contracts, while REIT investors own actual properties. When you look at your MIC investment statement, you're seeing your share of outstanding loans. When you look at your REIT investment statement, you're seeing your share of actual properties. A practical advantage is that MIC shares can sit in registered accounts like RRSPs and TFSAs, giving you tax-sheltered growth. This difference matters more than you might think because it changes everything about how your investment behaves. The value of your MIC investment depends on whether borrowers make their mortgage payments on time. If they pay, you get steady income. If they default, the MIC has to foreclose on the property and sell it to recover the loan amount. Your returns come from the interest spread between what the MIC charges borrowers and what it pays you. The value of your REIT investment depends on how well the properties perform. If the buildings stay occupied and rents increase, your returns grow. If vacancy rates rise or the local real estate market weakens, your returns decline. REIT performance connects directly to property values and rental income in the markets where they operate. When a MIC borrower makes their monthly payment, part of that interest payment flows to you as a dividend. The process is straightforward. The borrower pays the MIC, it deducts its management fees and operating costs, then distributes the remaining interest income to investors. Most MICs pay monthly or quarterly dividends based on the interest they collect. When a REIT tenant pays rent, that money goes toward property expenses first, then gets distributed to shareholders. The REIT uses rental income to pay property management costs, building maintenance, insurance, property taxes, and mortgage payments on any debt the REIT carries. After covering these expenses, the remaining cash flow gets distributed to investors as dividends. The key insight here is that MICs put you in the lending business, while REITs put you in the property management business. Each role comes with different responsibilities and rewards. As a MIC investor, you're concerned with borrower creditworthiness, loan-to-value ratios, and interest rate spreads. As a REIT investor, you're concerned with occupancy rates, rental growth, property values, and local market conditions. This fundamental difference in what you actually own sets up everything else we need to understand about these investments. Your role as lender versus property owner determines your income sources, risk factors, and how your investment responds to economic changes. Now that you know what you own, let's see how it pays you back. MICs generate returns through one primary source: the interest payments that borrowers make on their mortgages. Here's how it works in practice. A borrower needs $300,000 to buy a house. They apply to the MIC for a mortgage. The MIC approves them at a 10% interest rate. Every month, this borrower sends in their mortgage payment. Normally, the payment covers the interest portion of the loan only. The interest portion gets pooled with payments from other borrowers. Then the MIC distributes this interest income to shareholders like you. Let's say you invested $10,000 in this MIC. The MIC has $50 million in total assets from all investors. Your $10,000 represents 0.02% of the total fund. When the MIC collects $250,000 in interest payments this month, you get your 0.02% share. That works out to $66 for the month. If the MIC maintains this performance, you earn $800 per year on your $10,000 investment. That's an 8% return, though actual yields vary, and MICs often yield in the high single to low double digits with monthly or quarterly distributions. Your income stays predictable because mortgage rates are fixed. The borrower pays the same amount every month. You know exactly how much interest income to expect. Even with variable rate mortgages, the rates follow Bank of Canada guidelines. The changes happen gradually and predictably. Mortgage payments come in monthly like clockwork. Borrowers set up automatic payments from their bank accounts. The MIC collects these payments on the same dates each month. This creates a steady flow of interest income that gets distributed to investors. Most MICs pay out monthly or quarterly dividends based on this consistent income stream. REITs work differently. They make money from rental income, but they also benefit when property values go up over time. Let's look at an example. A REIT owns a 200-unit apartment building. The average rent is $1,000 per month. At full occupancy, this building generates $200,000 in monthly rental income. Over the course of a year, that's $2.4 million in gross rental revenue. But the REIT also owns the building itself. Property values can appreciate or decline based on market conditions. REITs offer rental income plus capital gains potential, but face vacancy risks and market cycles. If 10 units in that 200-unit building sit empty, monthly income drops from $200,000 to $190,000. During economic downturns, vacancy rates can climb higher. Some tenants might lose their jobs and stop paying rent. The REIT has to spend money on evictions and finding new tenants. This directly reduces the income available for shareholder dividends. REIT investors often watch funds from operations as a key metric that measures the cash flow generated by the properties. This gives a clearer picture of operating performance than traditional earnings measures. MICs deliver predictable income from fixed or indexed mortgage rates, while REITs' dividends shift with occupancy and market cycles. A borrower with a fixed-rate mortgage pays the same amount for years. Even with variable rates, changes happen gradually over months or quarters. Rental markets can shift much faster. New apartment buildings can increase supply and drive down rents. Major employers leaving town can reduce demand for housing. These changes affect REIT income within weeks or months. The stability difference shows up in dividend payments. MICs typically maintain consistent dividend rates year after year. REITs often adjust their dividends based on property performance. A REIT might pay 50 cents per share quarterly for 2 years, then cut to 40 cents per share when vacancy rates increase. MICs offer steady, predictable income from interest payments, while REITs offer potentially higher returns through both rental income and property appreciation. REITs come with more variability in both income and capital value. This income difference explains why MICs appeal to investors who want consistent monthly payments. REITs attract those willing to accept fluctuations for potentially higher long-term gains. But there's another factor that affects your investment strategy just as much as how you make money. That factor is how quickly you can get your money back when you need it. The ease of accessing your investment is dramatically different between these two options and affects your investment strategy more than you might expect. Most MICs are private companies, which means you can't just log into your brokerage account and sell your shares instantly. When you buy MIC shares, you're entering a private investment with no public market where buyers and sellers meet to trade shares. You can't open your trading app and hit the sell button like you would with a stock. The shares don't have a ticker symbol and don't trade on the Toronto Stock Exchange or any other public exchange. MICs typically enforce minimum holding periods, often 1 to 2 years, and may impose specific redemption windows. Getting your money out early might require finding another investor to buy your shares, a process that can take weeks or months. Some MICs have redemption policies that only allow withdrawals quarterly or annually, sometimes with penalties for early withdrawals that can reduce your returns by 1% or 2%. Each MIC is different, so be sure to read their documentation. REITs trade on public stock exchanges just like any other stock. You can buy and sell shares during market hours with a few clicks. Most REITs trade on major exchanges like the Toronto Stock Exchange. You can place an order to buy or sell REIT shares at 9:30 a.m. when the market opens, and your order can fill in quickly. The shares have ticker symbols like RioCan REIT trades under REI.UN. You can check the current price anytime during market hours. This liquidity difference creates a trade-off that affects your investment strategy in ways you might not expect. The limited liquidity of MICs means your money is locked up for longer periods. You can't respond quickly to changing market conditions or personal financial needs. If you need money for an emergency, you might not be able to access your MIC investment right away. This forces you to think more carefully about how much money you put into MICs as long as you meet their minimums. Each fund is different, so be sure to read their information in regards to their minimum investments. The private nature of MICs means they're less affected by daily market mood swings and investor panic selling. When stock markets crash, MIC values don't typically drop overnight. The value of your MIC investment depends on the underlying mortgage portfolio, not on what other investors think about the stock market. In 2008, most Canadian MICs saw stable valuations, says Mortgage Trends, while public REITs halved, according to Seeking Alpha, crowdsourced platform for investors illustrating private versus public volatility. While public REITs can see their share prices fluctuate based on stock market sentiment, interest rate changes, or economic news that has nothing to do with their actual properties. REIT share prices trade like stocks and thus swing on macro news, including Bank of Canada rate impacts. When interest rates rise, REIT share prices often fall because investors can get higher returns from bonds. The REIT properties might be performing well, but the share price drops anyway. This connection to broader market movements means REIT investors see more volatility in their account values. MICs offer stability through limited liquidity, while REITs offer flexibility through public trading. The flexibility comes with increased price volatility. Your MIC investment might stay at $10,000 for months at a time, while your REIT investment might swing between $9,500 and $10,500 over the same period. Both investments might generate similar returns over time, but the path to those returns looks very different. Your choice here depends on whether you prioritize having quick access to your money or prefer the stability that comes with a longer-term commitment. Investors who need flexibility choose REITs despite the volatility. Investors who want steady values and don't need quick access choose MICs despite the liquidity limitations. This liquidity trade-off connects to something deeper about what these investments actually represent. Next, we'll wrap up how to decide based on your need for access versus stability. The biggest factor in choosing between MICs and REITs isn't just risk tolerance, it's understanding that you're choosing between being a lender versus being a property owner. Each role comes with different responsibilities and rewards. Remember, MICs, 50% mortgages, flow-through income for predictability. REITs, 75% real estate income, public trading for liquidity and growth. If you want predictable income and can commit your money for longer periods, MICs align with a lending mindset. If you want growth potential and need flexibility, REITs put you in the property business. Start by honestly assessing whether you need quick access to your money and how much income variability you can handle. If this comparison helped you understand these investment options and is interested in learning more about MICs, be sure to watch my next video, The Inside Workings of Mortgage Investment Corporations.